Hello and welcome to the latest St James's Place investment update. Over the past few weeks, you will know that we've recorded a number of interviews with our investment managers, and today we wanted to take a slightly different tack and conduct an interview with some members of our investment committee. So I'm delighted to be joined by David Lamb, who is the chair of our investment committee, and Wyn Robbins, who is one of the independent members of our investment committee. David and Wyn, welcome.
Hello.
Thank you.
David, perhaps you could start by describing what the role of the investment committee is in normal times and your perspective on what you see the priorities are today in these clearly exceptional times.
Thank you, Tom. I think everyone knows that what we're trying to do in the investment committee is be comfortable that our clients' money is being kept safe and is being managed in the way that they and we would expect it to be managed. And that means essentially asking really sensible but important questions. What are the fund managers doing? How are they doing it? Do we think it's working? If things aren't working, what steps are they taking to change it? And how do we verify that we're getting the right sort of information on which to base our judgments when we get the answers back? And it's worth remembering that whenever we get this information, whether it's very old or very new or very recent, it's all historical. It's all about the past. And what we're trying to do all the time is make the right decisions and the right judgments about how do we make sure the client's outcomes looking forward can be achieved by taking this information and monitoring and managing the fund managers. And it does come down to this thing about judgment and making the right calls at the right time. And I think if you look at what's happened in the recent market volatility, it's not about changing that approach. It's just recognizing there's a lot more noise in the market, there's a lot more going on. So how do we make sure the managers are really clear about what their process is? That those that are making changes and changes have occurred, we know across the platform, are they and we comfortable about what the rationale is for those changes and why they're happening? And where they're not being changes being made, are we still comfortable that's the appropriate thing for those managers to be doing, so that we do have this view looking forward, that over the medium term, our clients' money is both safe and getting the returns that they should be getting.
Yeah, thanks, David. And maybe I can come back to that in a moment and we can dig into some of that in the detail. I suppose more generally, we're clearly living through for what is for most of us an unprecedented time in society, and also that is having a huge knock-on impact onto markets. And when given the breadth of your experience of a number of different investment roles, I'd be really keen to hear your perspective on the current crisis and how you sort of think has some different and similarities to things you've observed in the past.
Well, yeah, having been through one or two market downturns, I think in some ways they're all very different, but in others they have a lot of similarities. So, you know, what's different is how we got there in the first place and therefore how we get out of it. But the one way where they're all similar is that you get immediately a massive price dislocation. And, you know, we lose for a while the normal method of price discovery. And that's to say, when markets are trading normally, buyers and sellers kind of match and you come up with the right price. When markets dislocate, you get a lot more sellers than buyers, and assets tend to trade at prices which are certainly not reflective of their underlying value, which is where we are now.
And when is that the same across all asset classes, and have we seen sort of differences in the past few weeks across, say, equities and bonds?
Initially, in the first week, every single asset class performed badly. Even asset classes where we would normally expect them to be safe havens, such as US Treasuries or gold, they actually all went down at the same time, which tells you there was a massive rush for cash. Now, since we've had a very strong policy response from the Bank of England, the Fed, the ECB, and there's a lot more support for markets, things are normalizing to some extent, and we're seeing the price differentiation that we would normally expect. So obviously we've seen a rally in government bonds, gold's picked up a bit. Credit that was very badly bruised at the outset, particularly high grade credit, is recovering also.
Yeah, no, I think that's right. And I think it's a really important point, isn't it, that at the start of these sell-offs, everything goes down, and it takes a while for sort of quality to be realised almost through these periods. David, perhaps we can go back to some of the things that you just touched on about the investment committee process, and almost sort of take us right back to the start with, you mentioned that we're looking at data, historical data, and perhaps you could sort of describe the process that the investment committee goes through to appoint managers, and what it is that we're looking for at this current time to ensure that our clients' money has been looked after in the appropriate manner.
Thanks, Tom. I think the starting point needs to be is what's the mandate describing that we want the manager to try and be achieving for our clients. So what's the return expectations, what's the risk we want to take in that mandate, what's the area of assets we want the mandate to cover, and then working with our consultants, whether that's Stanford's or Reddington or Rokinson, how do we find the right people who can help convince us they've got the right skill set to deliver the returns we want to see across that mandate. And I think there are what I call qualitative and quantitative sets of data here. A lot of it is about numbers, and there's an awful lot of information about investment style, investment weightings, decisions taking, historical tracking, and all that sort of information. But perhaps not enough weight is given historically to the behavioural qualitative sides of things. And we spend a lot of time with our consultants understanding how decisions are being taken and why decisions and the decision-making process changes over time. When you have market dislocations like Wynn's just talked about, you can actually get almost two extremes of behavior. You get the rabbit in the headlights where a manager doesn't know what to do. And that can be as dangerous to a portfolio as where you've got a manager overacting and overreacting to what's going in the marketplace. And this analysis, which is both quantitative and qualitative, helps us, I think, get a good grip on where do we have concerns and are those concerns increasing or reducing over time. And we should recognize also, though, that we will find things out in market dislocations about our managers. We shouldn't be surprised if we start getting new information and new insights from some of the managers as a result of what's going on at the moment. It'd be very unusual not to get that. We also need to recognize that we have, through our previous monitoring, had our own plans for changes coming forward over the next 6, 12, 18 months in terms of managers and mandates. Those plans have got to be tested against the current environment to make sure our logic is still sound. And the information we use to do that can be enhanced by what goes on at the moment. So I think that's a really important point.
Yeah, thanks, David. And David, you touched on our use of investment consultants who are clearly independent from our process, who we seek advice on managers from. We also have an internal investment team, so my team, who are looking at our manager activity every day. And also the investment committee, and Wynn, I'd be really interested to know your perspective on what you feel the independent members bring in times of stress, like we're seeing at the moment.
Well, we've all been around a long time, so we've all seen a few business cycles and market cycles. And each of us had senior roles at very large institutions and very, very different roles at very different institutions. So we bring a broad spectrum of perspectives. We've also have been used to building and mentoring teams and challenging teams. So we bring that to the table. I think the mentoring and the challenging aspects of that role are very pertinent to the current situation. When we've got a reasonably young internal investment team who perhaps haven't seen as many investment cycles, and also, as David mentioned, having a look at our underlying fund managers and seeing how they're working, are they sticking to their knitting? And challenging the output from those is very, very relevant.
Tom, I think the point Wynn made there about balancing out the experience between the independents and the in-house team is a really important point. We've got a very talented in-house team, but I know they're going to laugh at this point, but I remember the 1975, 74, 73 crisis. Which makes it, I was at university in 1975, and I remember the 3-day working week and studying by candlelight and all that stuff. And it did felt very, very real at a personal level, going through a crisis like that. I remember the 1987 crisis, and some of our in-house team probably weren't born. In fact, probably none of them were born at that time. And you learn from these events. You really do learn to give perspective and context to these events. And I think that can be really helpful to a younger team who are talented, and they really are talented, our team, to help them realize that there's a way forward here.
Yeah, thank you. And we've obviously been having regular interaction at the investment committee for the last few weeks since this emerged. Perhaps David Alwyn, one of you could describe a couple of pieces of information that you found particularly useful. And David, I know you mentioned about we're learning things that we're going to go back to in the future period. But is there anything that stands out to either of you which is particularly an area we need to focus on?
Yeah, I think for me, one of the things the in-house team has managed to do for us over the last few years is give us a much greater clarity on the moving parts behind the performance story within the funds. So the style attribution analysis is developed really well. The ability of managers in terms of the results versus their record and the trend analysis versus the point in time analysis is developed really well. And I think we've honed those tools on the back of experiences gained in the last 3 or 4 years, actually, which I think helped us going into this crisis. We had reports coming to us which are certainly an improvement on where we were 5 years ago. And I'd expect us to continue to do this evolutionary improvement process going forward.
Yeah, I'm with David. I think that the information that you guys are feeding back from your interactions with the fund management teams is much more immediate than we had in the past. So, you know, for example, we're now having weekly calls on the IC, and at yesterday's call, we were interested to see whether those managers who've been running larger amounts of cash had actually started to put any to work. Because certainly, I guess it's certainly my opinion and probably most people's that, you know, this is probably a good entry point for markets. It's not to say it won't get better, but actually, if you look back on a 1 to 2 year view, you're probably going to do very well by putting cash to work right now. So it was interesting to hear from the investment team, you know, which fund managers had started to employ cash, which areas of the market they were looking at, and which particular stocks, for example.
And I think that point about the speed at which we're getting that insight and the fact that our in-house team are going direct to the managers whenever they need to, frankly, on a daily basis, in some cases, picking the phone up and getting involved in the conversation about the stocks that are going into the portfolio and why they're going in at that particular point in time, is giving us that really much stronger feedback loop than we had before.
Yeah, and I think that's a key part of what the team's doing. It's looking at, because they are SJP's own funds, it means we have access to all the trade information. We can look at exactly what the managers are doing rather than relying on what they're saying. And we're systematically gathering all the information from managers. So anything that they're pushing out to their other clients and also reporting to us, we're just documenting absolutely everything. So we've got that paper trail to go back on in the future to test those points that you've both teased out.
Yeah.
And I suppose a lot of clients will be sitting there today concerned about the value of their investments. Perhaps we could maybe just talk about the performance that we've seen. Clearly, headline numbers in markets are pretty scary when you see things like the FTSE's gone down more in the first quarter this year than it has ever since 1987. Is that the sort of performance that our clients can expect to see coming through from their SJP investments?
I think one of the strongest things I think you can take from the performance data at the moment has been the power of diversification and the importance of the way the portfolios have held up versus an individual market. And I think that's been a good message for clients about making sure you have a diversified portfolio in the first place. But I think the reality of Wynne talks about market dislocation and prices. I don't think today's market price or an individual share price tells you what the value of that business is. I think that's just something just indeterminable today. There'll be some businesses out there will do really well going forward, but not all will. And I think one of the key things that fund managers are going to have to do is be really clear about which companies are going to survive and prosper from this current crisis and which ones are not going to survive and prosper. And if anything, I think the current environment and the current figures are masking the real debate behind the scenes for me, which is getting the right active managers to make sure you've got the right companies in your portfolio going forward.
And when there's a lot of headlines starting to come through at the moment about dividends being cut, and the PRA have obviously issued their guidance to banks that they ought not pay dividends this year. For our clients who are perhaps less familiar with investing in bonds than in equities, perhaps you could sort of describe how you see the income generated in bonds being perhaps different to things like dividend income in equities.
Yeah, well, if we look back, towards the beginning of this year, fixed income markets pretty much had nowhere to go, if you like. We have very, very low levels of interest rates, yield curves were flat, pretty much every market yielding the same. That's changed, and credit spreads have widened, so the price that, for example, high grade, well, all companies pay to borrow over the cost of government borrowing has increased. And I would say, talking to the fixed income fund managers that I know, there's now a sense of hope because we've actually got some meat in the market. The one thing to remember about bonds is that they rank much higher than equities on a company's balance sheet, so they're senior. So a company can forego a dividend, but it's virtually impossible for them to forgo payment on a bond in terms of servicing the coupon without defaulting. So, for those investors that are looking for income, the bond market is more likely to offer them returns for the foreseeable future than the equity market.
Yeah, I think that's a key point, isn't it, Wyn, that unless those bonds default, then you are going to get the income which the coupon implies, and some of our bond funds today are yielding over 7%.
Yes, absolutely. And there's been record issuance in the corporate bond market in the last couple of weeks, and some very good companies borrowing, and others. I mean, for example, Carnival, the cruise operator, raised 4 billion in issues that were oversubscribed, and they paid a very high coupon for it. But they're making sure that they have cash flow for the next 9 to 12 months. So yeah, there's some very good opportunities out there at the moment.
It's interesting. I was interested to hear Hamish talking about pretty much zero interest rates for a very long time going forward in terms of his outlook the other day. And you think about a 7% diversified bond portfolio against a 0% interest rate. And if you're investing for income, that's an interesting conversation.
Yeah, it is. It is.
Yeah, and the other challenge is clearly that for as long as a lot of people can remember, we've had no inflation.
Yeah.
Whilst clearly there's that prospect of low interest rates for a long period of time, the combination of this economic stimulus and the supply side shock, we may get a period of inflation. And having managers who are able to react to that, I think, is a really important thing for us to have going forward. We're almost out of time now. So, Wyn, are there any sort of closing remarks that you want to make about that will help give clients sort of comfort in the oversight that we have over their investments?
Yeah, I mean, my advice would be don't panic. I mean, it's never good to look at your portfolio and see that it's worth less this week than it was last. It doesn't make anybody feel good. But remember that crises do end. We do come through it, and in every case, markets end up higher than they were before. So if you don't need to sell, then don't. If you've got cash, this is not a bad time to be looking to invest some of it, and talk to your SJP partner, because that's what they're there for.
Yeah, thanks, Wyn. David, any closing thoughts from you?
Well, I joked earlier on about being around for the 1973-1974 crisis. So I want to quote from a letter that was written in November 1974 by Jim Fullerton, who was at that time the chair of Capital Group. And what Jim points out when he wrote this letter in November 1974, no one wanted to invest at all. This is the Dow Jones index was 40% below its level in January 1973, and everyone thought the investment was over. And he chose to write a letter to his clients to explain why investing for the long term was still the right thing to do. So he looked back at a previous crisis, and he went back to 1942. And on the 11th of April 1942, in the New York Times, it wrote about the fact that every broker in Wall Street was saying that there was no future in investing, because it was a really black time for the American economy. American forces were losing. Britain had been kicked off the beaches of Dunkirk. The Germans were going to beat the Russians in the war, and the US government might have to raise taxes or introduce price freezes. And And this is the 11th of April 1942. This article appeared in the New York Times. And yet on the 28th of April, the market turned. And Jim asked the question, why did the market turn? And the reason was because people realized in the future the companies that are well capitalized in America would survive. The businesses would return to fruition. And despite all the doom and gloom around now, there would be a future for these companies. And he ends the letter by quoting what Dean Witter said when he wrote about a previous crisis. And Dean Witter wrote in 1932, at the bottom of the Depression, before the market had quite reached its bottom, he said, when the future is clear, the present bargains will have vanished. Mm-hmm. In fact, does anyone think today's prices will prevail once full confidence is restored? And he wrote that letter 3 weeks before the market turned in 1942 and in 1932. So we've been here before and we've prevailed and survived. I'm certain we'll do that again.
Thanks, David. And I think that's a great place to finish off. So Wyn, David, thank you for your time. For anyone who wants to access any of the other videos which we've been recording with our fund managers, then please refer to either your partner's website or sjp.co.uk. Have a good day, everyone.